Last week, we talked life insurance or retirement, specifically cash value life insurance, and how it can fit into retirement. Be sure to check that out. This is our Halloween special. And for those of you watching on YouTube, you get to see our costumes that we have on here. So if you're just listening to this, be sure to go check out our YouTube, hit that like button and subscribe while you're there, and check out the visuals that we've got going on with this particular podcast. Today, we're going to be talking financial horror stories. Each of us has a financial horror story, and I may end up giving a bonus one at the end of this one that's really scary. So stick around. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
My name is Jane with Tax Exempt Millionaire Club.
And I'm Carlo Vaquero with Net Wealth Finance.
Welcome back. Each of us has had some pretty traumatic financial events that have happened. These are our financial horror stories, perfect for the Halloween special. Who wants to kick this off with their financial horror story?
So when I first started, before I actually started real estate investing, I participated in 2 syndication deals as LP, so-called limited partners. One, actually, they returned us the money, the principal plus interest earlier. The second one became a horrible story. So I invested with 3 guys, A, B, and C. I invested with A as a sponsor. And then B and C, I believe B is actually local. He lives in that city. It's a huge apartment deal, $80-something million. The whole situation, the property management got so bad. There's gangsters, drugs, gun shooting, prostitution. The lawsuit later on was $3-point-something million. So we lost that 500-something doors in one portfolio. They bought the whole big piece of portfolio. So the lesson learned is do not trust local experienced operators, and they could oversight certain property management, and they discovered it so late. It took them almost a year and a half to clean up and get right people in, pull the bad people out. And the A I invested actually bought the whole entire portfolio. So in theory, we lost it. But he said any investor invested through him will not lose a penny. So the 5-year investment will become 9 to 10 years. Hopefully, finger crossed, we'll still get our principal back and some preferred returns. I believe we got maybe 1 or 2 so-called preferred return when they dispatch for a quarterly interest. So that's really a horrible story. I hope any of you in the audience will never lose money in your real estate journey. But you never know. So everybody vent all the operators, vent the deal itself. Also know the bigger environment. Sometimes when the interest, another issue about this whole entire thing is they got in really, really high. They bought the whole at an entire peak. They get so many different regular commercial loans, some martini loans, some bridge loans. They have very, very high interest. So eventually they just had to close down that LLC. So that's my lessons learned. So hopefully it will never happen to any of you in your real estate investing journey.
So the solution is to do a better job vetting, you think?
Definitely. Due diligence. Do your homework. Feel very comfortable who you are invest with and who are actually operating it. As limited partner, there's really not much we could do other than just push the money to that side of the table, and they will do the operation. They will give us all the financial information financial report. So basically, know what you are getting your money into, and eventually, hopefully, it's a happy ending instead of this horrible story to lose. Oh, by the way, the total investment on my side is 100K because I think that's the minimum. The portfolio is too big. They cannot take 25, 50K smaller investment.
Well, good luck. Hopefully you'll be able to recover that. I'm going to hop in with my horror story, my first horror story, and it has to do with kind of what set me along on the life insurance financial journey that we're on today. And this is back in 2006. My wife's grandparents sold their restaurant, and they figured they had enough money to last them for the rest of their life. They were going into retirement. They ended up meeting up, and their quote-unquote financial advisor was a life insurance salesperson who ended up getting them into a variable life insurance policy. Lo and behold, 2008 rolls around. Almost all of their money went away. They lost at least half of it. And because this is something they were planning to use for retirement, they had to pull out money every single month in order to live on it. They didn't have their restaurant anymore. And so they ended up running out of money and going bankrupt. Nobody should commit every single dollar that they have in their retirement in one product. Certainly not a variable product that leaves you 100% at risk in the stock market. That's the lesson from this financial horror story. I can't say that this has a happy ending. There's nothing I could do to help them with that. I didn't become a life insurance agent for another 10 years after the great financial crisis of 2008, or whatever they called it, the Great Recession in 2008. So I was unable to help them at the time. I wasn't in this space, and they just didn't have the knowledge, and they relied on this financial advisor who concentrated all of their wealth in an at-risk investment that you would otherwise think it's life insurance. It's got some safety triggers in there, and it does not, come to find out. Carlo, tell us your financial horror story.
So my horror story, I've mentioned it a couple of times on this show, is related to my dream of having a boat, or a sailboat, or some vessel that I can travel the world in. And I do own that boat. The idea is a tax strategy with purchasing a boat and running it as a business. It's one of these things that you can use depreciation, specifically bonus depreciation, to offset income from whatever source. So sounds like a great strategy. Like, it is something that made sense to me because I wanted to have a boat. And I invested a good amount of money into purchasing a nice boat. It's got 5 cabins, 5 heads. It is a boat that you can travel the world in. All the things to be kind of off-grid, some solar, generator, all fantastic stuff. It's a boat called Harmony. Actually, this is one of my T-shirts from that. And so love the boat. It's a sailing catamaran. But the day before its first charter, so I had bought the boat, outfitted it. So I'm into this thing for hundreds of thousands of dollars. And the day before the first charter, it's already been provisioned. I've got a skipper. So it runs crew charters with a captain and a chef on board. So all-inclusive crew charters. And the day before that first charter, it gets struck by lightning. So it fries everything. And there's a lot of stuff that goes on in between this and today. And really, that's, you'd think that'd be enough. And my deductible at the time was $20,000. So I was out of pocket. Well, I had to pay out of pocket for all of the things. This is where I use my life insurance to front the costs on these things. But no matter what, I was still going to be out of pocket for $20,000. And at the same time, I'm bloating the cost of the boat mortgage, the insurance. So a lot of expenses involved. So I'm out of pocket for all of these costs. I do get reimbursed for the majority of the expenses for the repairs for that lightning strike, because my deductible at the time was $20,000. Then I was like, oh, well, it's the off season. I want to bring the boat up to where I'm at. I'm in the mid-Atlantic area, the Washington, D.C. area. I was like, I'll sail it up and have it be by me for the off season. So storm season is between August and October, November-ish timeframe. So I do this passage, sail for a little bit over a week from the Bahamas up to, I started the trip in Fort Lauderdale and up the coast, off the coast, offshore, sort of in the Gulf Stream, and arrive in Northern Virginia, coming up the Chesapeake, and get situated for the night. So the day after we arrived, though, I'm home now. My skipper, he stayed on the vessel, and I get a call from the marina the day after we arrived, and they say they think that the boat was struck by lightning. It was a crazy lightning storm that happened that evening. I remember seeing it and hearing it, and I was like, oh, there's no chance that it's going to hit my boat, because I'm not too far. I was about 45 minutes from that marina is where I live. And sure enough, my boat was struck by lightning a second time, over 1,000 miles away from the first lightning strike. So the odds are just unbelievable. And on top of that, it turns out the annual slip holder for that slip wasn't there because he was struck by lightning there in that location previously. So it's just insane odds that this would happen. And the second lightning strike, like with the increase in the number of lightning strikes, the deductibles for lightning strikes actually went up for the second one. So I was out for a much higher deductible, $120,000. And effectively, that's all out of my pocket, because that's basically what it costs to repair it. Nothing was covered by insurance. And so lots of money outflows for this situation. And life insurance is a big part of how I am floating those costs while I recover and try to generate more revenue from those charters.
Yeah, so that first lightning strike knocked you out of the whole first season that you were expecting to run, right?
That's correct. It knocked me out of the whole first season. The second one was sort of off season, so it knocked out a few charters. So it wasn't as bad, but still not great in terms of lost revenue, losing a few charters. But the issue is just that big deductible pretty much is a really big expense.
Crazy. Well, let's hope for no more lightning strikes for Carlos Bud. Good luck. And I'm going to finish this up with another horror story on my part. And this really speaks to the value of what we preach about here, which is storing our cash in high cash value life insurance that's properly designed and has very low expenses and easy access to it. Carlos, for sure. But outside of life insurance, and I have now 13 policies, but outside of life insurance, I like to play around in the stock market. I like to play with options. They've always been attractive to me. It's an excellent use of capital with the opportunity for really good returns, except options can be dangerous. There are ways that they can be used as insurance. There are ways that they can be used to make a portfolio safer. And there are ways that they can be used for speculation. And back in 2020 and 2021, I was using them for speculation. And I was having great success. I had a $25,000 portfolio that I got up to $150,000 over the course of just a few months. And then in 2021, the GameStop fiasco happened, where GameStop shot way up. And the first time it shot up, I was on the right side of it, and I made some money. I made a little bit of money. I didn't make a lot of money because what I was doing, I thought I was being fairly safe, even though I was taking a little bit of risks on potential stocks like GME that would run up like that. But I made a few $1,000s, and then GME came back down, and it kind of traded sideways and down and sideways and down for a little while. And I decided I was going to get in on the opposite side of the trade for a little bit and sell some covered calls. Well, my account was big enough that I could get portfolio margin. And with portfolio margin, when you sell a covered call, you can sell it naked. So it's a naked call that you can sell. And if it's really, really far outside of the money, you can get $25 in premium for a few days of holding this covered call, for selling this covered call. And it only uses a very small bit of margin, like $1,000 in margin or something like that. So the return over a few days was like a pretty decent return when you annualize it. Well, GME was trading around $30, I think. And I was able to sell like the $300 strike price, expiring that Friday for 25 cents, which essentially gives you $25 because the call option is 100 shares. I did this on a Wednesday, and these options expire Friday. Lo and behold, throughout that day, it just kept trading sideways, and I was thinking, I'm sitting on some extra cash in this account. I'm just going to sell a few more. And then a little while later, I sell a few more, and then I sell a few more. And I sold probably, 8 or 10 of them by the time it got to close to the end of the trading day. The last hour of the trading day, it started to spike up, and it moved fairly quickly. It jumped fairly quickly. And suddenly my margin went from requiring 1,000 to requiring like 4,000. And I thought, ooh, that's a little scary, but it only jumped up from like $30 to 40 or 45. I'm far away from this. Although I did sell some at the $100 strike as well, but just a couple of them. But most of them that I sold were like $175 or $300 on the strike price. As soon as the market closed, GME shot up to $175. And my margin requirement went from about $4,000 up to over $300,000. I was panicking. I didn't have that much in that account. That my whole account at the time was like $150,000. And you can't trade options when the market's closed. You can't close them. You can't do anything. And the broker that I was with, it was Thinkorswim, and they, at some point, it ended up coming back down, but at some point they panicked and ended up covering my position with shares. And they bought those shares when GME was up pretty high. Well, that's them covering the position. I called them in the off hours and I said, what do I need to do here? Like, I just need to roll these options out, because you can buy back the options that you sold and sell ones that expire at a later date. And in this situation, if I were to do that, I could actually recognize a profit, because the ones that I could sell that expire months from then, I could get like a $25,000 or $50,000 premium on. Well, I couldn't do anything at that point because the market was closed. And so they said, just call in the morning and, we'll figure it out. I tried to call in the morning and they put me on hold. And I was on hold for almost an hour, starting before the market opened. And before the market opened, GME was coming back to reality. So it was still up around 175, but it came all the way down. At market open, it was right near 100. But my margin call was still way high. And right before market opened, while I'm on hold with their trade desk, they started selling all of my positions as soon as the market opened. They started selling all of my other positions in order to cover the margin for GME. And I finally got a hold of somebody and I said, stop selling my positions. Like, all I need to do is roll. And when the market had opened, their software system wouldn't let me roll it either. So I had to talk to somebody at the trade desk. So I said, stop. All I need to do is roll this out, or else I can send some money. And they were like, oh, well, you need to talk to the trade desk. They transfer me to the trade desk and I'm on hold again. Meanwhile, they continue selling my position. They completely sold my whole account and sent me a bill for $30,000 at the end of it, because they sold everything. Nothing was left in there by the time I got to talk to somebody at the trade desk. And I talked to lawyers, and they said they can do whatever they want. That's basically what a margin, that's what you sign up for when you're using margin. So that was a very expensive lesson. $150,000 down the drain. Had to come up with, well, I actually didn't send them extra cash. We settled on a much smaller number when they sent it to collections, because I was refusing to pay for that as I was hunting around and talking to lawyers, but I was not successful in that regard. So the lesson here, do not rely on using margin and having any sort of control over your account. Your brokerage firm can increase the margin requirement at any given time, and they can close your other positions anytime they want to in order to cover that margin call. Generally, they will give you time. They always say they will give you time, but the reality is they may panic and decide to not give you time, in which is the case that they didn't hear. The move that caused me a problem happened after the market closed, and the very next morning, right as soon as market opened, before I could talk to anybody, they sold out my entire account. So they didn't even give me any time at all to cover that margin call. That's crazy. Now, the reason we love high cash value life insurance and what storing our money there is because it's very liquid. We can access almost 100% of the cash value for policy loans, and there's no margin calls that will happen. That just doesn't happen in life insurance. Whereas if you're using margin in a stock brokerage account, you might be able to borrow 30 or 50%, but you are always at risk of a margin call. If something happens in the market that was unexpected, there could be a flash crash that happens. There could be an incident like what happened with GME, where there was a short squeeze. You just never know. So lessons learned in that regard. Fortunately, we had quite a bit of our funds in life insurance, and we were able to weather the storm, and we're back now stronger than ever. But that is a horror story that, I think people don't get tired of hearing that one.
In that situation, it might be prudent to put in some preemptive exits or stop losses with the foot of a trade, right?
You never want to sell a naked call. That is basically the lesson. You're always at risk of something like that happening. It's very rare, but it happens. There are definitely safer ways to trade options, and I advocate for spreads where you're always covered. So you don't sell a naked call. You either have a long call that either takes the place of holding the actual shares, and you're selling a call against that. That's called a covered call. Or you're doing a spread where you might sell a call, but you'll buy a call at the same strike or at the same expiration, but a different strike price. And that's your stop. You know what your maximum loss is in either of those positions. Whereas a naked call has an unlimited loss. That is the potential. And the portfolio margin enticed me into that with the thoughts of just getting slightly better gains on a little bit of money over a couple of days. And it cost me a lot.
Yep. Lesson learned.
Lesson learned indeed.
That's why we always want to diversify, right? Not only diversify to have different returns, but also diversify the risk. We don't want to put eggs in only one basket.
Okay, what's funny about what Jing just said is that she has a costume of a rabbit. So eggs in a basket, and it's coming from a rabbit. So kind of funny. All right, let's wrap it up for this week. Next week, we are going to talk about IUL as we kick off November. November, we've dedicated as IUL month. We're going to kick it off with IUL. What is it? Call the history of action. And each week, we're going to bring you something new that you need to know if you're interested in an IUL. So we hope to see you next week. Signing off. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And my name's Jane, your host of Tax Exempt Millionaire Club. If you're not a member of our community, scan the QR code to join. I'm also licensed in multiple states as an independent life insurance agent. Happy to connect anytime. Reach out.
And my name is Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you next time.
Happy Halloween.
Thanks for watching.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.